Hey, today our guest is Corey Clark with Advisors Accelerator. Corey's an insurance expert, so we have him on today to give us a little background about insurance and the different variables with insurance and people's needs, specifically around life insurance. So, Corey, why don't you give us a little background about yourself and your company?
You've been my accountant for, 7, 8, 10, 20 years.
Everybody doesn't need to know that.
Not exactly
But
sure.
yeah, I know.
Okay.
But it's for everybody's benefit.
We'll cut that out.
So it's good.
Yeah, so we work primarily with high net worth individuals, small business owners, medium-sized business owners, and work on customizing insurance strategies that don't just act as insurance, but act more as a tax shelter option or a way to mitigate or eliminate potential tax liabilities.
Nice.
So a lot of the clients we work with, they've taken a lot of risk in building their business, be it lines of credit or hiring and firing people and those kind of risks. So when it comes to their investments and their protection, if they can find a way, generally speaking, to mitigate or eliminate a lot of that risk, they want to do it because they've taken the risk in building the business, right? So a lot of what we're doing is using different insurance strategies to build out options so that, in essence, the IRS gets less.
Nice.
Whatever is left, right? So that's kind of what we do, big picture. So I don't, is that an answer?
It does, absolutely. Yeah, I know what you do. This is just for everybody watching. So we'll start out with a couple basic things for just any viewer or any client that has wants to know about stuff. Why do people need life insurance? Because I've had clients ask me that. It seems like it answers itself, but
kind of the contrary opinion would be, I would say not everyone does. But for people that do, it's, obvious one is, do you love your family? Or do you have assets and liabilities that need protection? One, right? Two, is there things within your life, be it your estate or your tax liabilities or your family or your business interest or your church or your charities or whatever it might be, that when you pass, if there's an estate issue, you would rather the kids or the grandkids not have to scramble together to pull out a line of credit and go donate blood to make sure that they can pay for the funeral and the estate tax bill, right? So a lot of the folks we work with in recent years with the estate tax changes and lowering and raising those limits, things like that, those are largely under our control. But a lot of people don't realize when you add the 401k together and the IRAs and the house and the car and the business, a lot of people are closer to that limit than they would otherwise realize. Right?
Yeah.
And then when they pass, when you add in inflation and rates of return, do you want the government to get 10, 20, 30, 40% of your stuff? A lot of people don't, right? So that would be kind of bucket one of those people. Two is a lot of people see insurance as a necessary evil, right? Kind of like my car insurance or my homeowner's insurance. If I T-bone somebody on 270, thank God I have good insurance. But if I never need it, it's been a waste of money for a lot of years, right? And most people see insurance as that if I'm healthy or I've paid off most of my debts, I don't necessarily need insurance, right? But if you can build it in a way where it's not as much of a cost and you can build it as a savings, then it makes a lot more sense to have insurance. Now, not everybody can get it because it's going to be dependent on age, sex, health, all those factors, obviously. But I think there's a large portion of the population that this would be an option for. They're just not aware of it, right? So if you look at recent LIMRA studies 2-3 years back, outside of your employer-based plan, only 45% of Americans have any kind of insurance in place other than what their boss gives them as a death benefit. Yeah.
I did not
So
know that.
a lot of people just don't have it, period, because they think it's cost prohibitive or what have you. So.
Yeah, because I've had clients where we go and we sit and we look at their finances and their tax situation, and there's no life insurance, and I think there's a disconnect between, we all want to think that we'll live forever, we all want to think we're not going to die, but a lot of people that are in the position of being the breadwinner in the family generally think that, but if something happens to them, their family doesn't have liquid assets, or like you said, the business clients, hey, if dad's got a bunch of bills to pay, dad passes away, all we have to sell is that business, which is not liquid.
How long is that going to take to sell it? And at what price?
At what price with dad gone? And there's even insurance vehicles that can take care of that, as you explained to me. So So another general question clients have is, say, what's the difference between term insurance and whole life insurance products?
I mean, the 30,000-foot view, kind of the one-on-one answer. Term insurance is you rent your house. Permanent insurance or whole life insurance is you own the house, right? When you own the house, you own the property, you can build equity in it, you can deduct certain things for tax purposes. You know, when you rent a house, it's quote unquote cheaper, but you have no equity, you can't sell it, you can't leverage it with other assets, you know, things of that nature. So on the face of it, term insurance historically is a lot cheaper. But is there going to come a point in time when the cost of the insurance becomes too expensive? Because when you're 30 and healthy, it's really inexpensive. It's $25 a month for $1 million in coverage, let's say. When you're 70 and you've had 2 heart attacks and you have diabetes, what's that same coverage?
Or can you even get it?
If you can even get it, that's right. You know, so the idea of permanent is upfront cost is much, much more. Over time, that cost of insurance goes down because the insurance companies know if it's permanent insurance, they're on the hook. Be it tomorrow if you get hit by a bus or when you're 120. They're going to pay out eventually. With term insurance, historically, 2% of policies pay out, right? So the insurance companies love that because they know I've got a
2%.
About 2.5%.
Wow.
Right? So if I've got a pool of 1,000 people, that's all term insurance, and they're all in their 20s, I'm loving that as the insurance company because I don't need a whole lot of reserves because I know that not many of those people are going to die.
Yeah.
Right now it happens, you know, thank God you have it if it happens, but where they're really on the hook is when they have the 70-year-old with a permanent policy, it's going to pay out eventually, right? So the reason it's been more expensive your entire life is because they factored in that it's going to eventually pay out, right? So,
Yeah. So the term's only 10 years or 20 years.
10,
and after
15,
that, it
20.
expires,
Mhm.
and you can't just renew it automatically at the same rate or anything like that.
Generally speaking, no.
Yeah.
I mean, there's caveats there, and there's minutia, but generally across the board, all different insurance companies, it's their goal with term insurance is to make it as attractive and cheap as possible, and then have it expire before you do. Right? If they can accomplish that 10,000 times over, they turn a pretty good profit.
Yeah.
Right? You know, with permanent insurance, it's for the same level of death benefit, it's going to be a lot more expensive. There's no question about it.
Well, there's a savings component too, right?
Correct.
You want to go into that and explain how that works?
So the general idea, and again, if any compliance officer was watching, just there's differences, right? These aren't necessarily recommendations and types of insurance, but generally permanent insurance by law has to have a cash value component, meaning if I throw X amount of dollars in per year, a certain percentage is going to go to the cost of the insurance, set aside money for the death benefits, so the insurance company can put money in a vault, grow it at 4% and buy bonds with it, right? Then a portion of it, assuming I don't die, by law has to go back into the cash value, has to go back into things like dividends, and over time, you get a rate of return on that, you get a cash value option. So much like, say, real estate, and we have a lot of clients that are in real estate, right? If we can assume over time that the value of the property grows, you build equity in that. Can you then go access that equity and do things with it, right? Now with life insurance, when you access that equity in the policies, you're gonna have some major tax advantages on that front, right? Because insurance, by law, any of the proceeds, if it's structured correctly, no capital gains, no ordinary income, right? No estate tax issues to speak of, right? So with the permanent policies, I always tell clients, your goal is not to go beat the market and go try to chase the S&P and go get 20%. That's not really what you're doing. This is kind of a bond replacement. You're going to get what you're going to get, but it's consistent and it's not going to be taxable. So if you're a high net worth individual or you have a high income, you know this on the tax side of things, right?
Yeah.
If you make $1 million a year and you go, well, my investments went out and got me 8%. Well, did they really? Because the tax brackets you're in,
Yeah.
did you get 5, 6, maybe 4%, right? With the insurance piece, as it builds a cash value, that's not taxable, regardless of your bracket, capital gains or ordinary income, right? So it's a good component for a lot of people. You know, if you look at the kind of the pie graph of somebody's total assets in the portfolio, is it a replacement of the bond piece? Is it a cash replacement? Things like that. So then your other investments can go to other things and you know you have a fallback position, so to speak. I'm kind of talking offhand here.
No, that's important. Yeah, that's
That's
what,
kind of the biggest differences there between the two.
yeah. And one thing that you've told me about being a client of yours is the asset protection aspect of life insurance. So you want to explain that about, hey, what's the, if you have a business and things go badly, you have to close down, what's the asset protection side?
Similar to, if any of your folks are familiar with your property and casualty insurance, right? You have an umbrella policy for obvious reasons, right? If you own rental properties and someone slips and falls on the ice and cracks their head open, right? The umbrella policy is there for a reason so that they can't go to you directly, right?
Yeah.
So you tuck things inside an LLC. Similar with insurance, anything inside the insurance policies, the cash value, the dividends, the death benefit, right? They're all lawsuit protected, right? So you can have your insurance policies, say, inside of a corporation, right? And then put that corporation, say, inside of a trust. And these are all more high-end lawyer kind of estate issues. But you can hypothetically do these things. And then if there is a lawsuit or there's a bankruptcy or pick your poison, right?
They're all protected.
They're all protected, right?
Yeah.
So if you have to go to court for whatever reason and they want XYZ for damages, those things don't even exist on the map.
Yeah, that's a great planning strategy. I think not a lot of people are aware of. Whereas if you had this money in a brokerage account, hey, that's an asset that creditors can seize. But if you have money in life insurance, at least in Ohio, hey, it's untouchable because it's there as a benefit. So that's always something I thought was kind of cool. It's not real well publicized, I don't think.
Oh, sure. I mean, we talk a lot about in the investment world, it's what's the rate of return on X or Y or Z, right? What's the stock going to give me? Well, with this, it's, again, you're not going to go beat the market, right? But there's an internal and the external rate of return, right? If it's able to provide you lawsuit protection, if it's able to avoid capital gains or ordinary income taxes or estate taxes, what's the real rate of return at that point?
Yeah.
If we're going out and getting a pedestrian contractual guaranteed 4%, but it's a tax-free 4%, and you make $1.5 million a year,
Yeah.
what are you netting?
Yeah.
Right? So that's the big picture of that, but yeah.
Yeah, very good. Very good. That's something that I don't think a lot of people really are aware of. That's an advantage on the insurance side. So we get a lot of questions about annuities, and annuities are an insurance product.
Sure.
You want to explain what an annuity is for everybody? Or?
To put it simply, and not to dumb it down too much, but the idea is I give an insurance company a pile of money, right? And based on interest rates and their exposure, they'll say, okay, we'll guarantee you X per month for the remainder of your life, right? Or the remainder of your and your spouse's life, or your individually, or for a certain period of time, right? So years ago when interest rates were relatively low, if you look at insurance companies' balance sheets, annuities were about 10% of what they did, because nobody wanted to put a bunch of money into something and go get 2%
small
back.
interest rate back. Yeah.
Well, one flip side here of higher interest rates, it stinks if you want to go refinance your house. But, if I can put a bunch of money into an annuity with a quality insurance company, and they can go get me 5.5%, 6%, on a monthly basis.
It's guaranteed, right?
Payout, depending on the annuity, but yeah, there's variable annuities, there's fixed annuities, right? Variable annuities will have some form or fashion where they'll ride with the market. You'll have an upside and downside protection. Then you have fixed ones where they just say, okay, here's the interest rate we're going to give you. Now, if you're 25 years old and you're starting out, annuities make not a lot of sense because you want a better rate of return, you want more liquidity with those things. But if you're 70 and you want this to be a supplement to your Social Security and the sale of your business, and you don't want a whole lot of risk in the portfolio, it's a different story entirely. And a lot of annuities too will have whatever the premium deposit was. Say I threw $1 million into the annuity, that's guaranteed as a death benefit, right? So you pass away 2 years into the annuity, the payment stops, but that premium is returned to the estate as a death benefit. So it's going to be potentially, depending on qualified or non-qualified money, tax consequences of that. But it's a solid, and we've done a lot in the last, I'd say, 18 months, just because a lot of retirees, pre-retirees go, okay, look, I've got my social security, it's gonna give me X per month. I've got my state teachers, it's gonna give me Y. You know, husband or wife sold the business, so we have this. Like, do we wanna go put this in the market right now? You know, I'm not Nostradamus, but a lot of people in their 60s and 70s are saying, I'd rather just kind of wait and see what happens. So let's put it into the annuity. We'll go get 4.5%, 5%, 6%.
Yeah.
And you got the house paid off and all those things. So it's not a lot of risk.
Yeah.
You know, and with higher interest rates, make a lot more sense than they did 3
years ago. Yeah. That's very good.
Yeah.
Thanks for explaining that. So, yeah, and then you talked a minute about variable annuities. So variable annuities are the ones that's tied to a market index or some other such thing, and then the insurer would assume some of the risk on that. Is
Sure.
that how that works too?
Sure. So
Yeah.
on a variable annuity, the idea would be, insurance company will say, okay, we'll give you a floor. Let's say next year the Dow Jones, which this annuity is tied to, does a negative 30%, right? You might be capped at negative 10, hypothetically, right? You know, but then the upside would be, okay, if the market does 20% next year, you might only get 12, but you're still going to get upside.
You get it. Yeah, you get it.
On that, right? So the insurance companies, from an actuarial standpoint, have to figure out, if all these people give us all this money, how do we give it back to them and not blow up,
Yeah.
right? You know, because they can't set up a Ponzi scheme.
Yeah.
Right, so they got to, just from an actuarial standpoint, they run the math and they know what their numbers are. And then with annuities, the longer you live, the better they get. Because the insurance company has to pay as long as you're alive, generally speaking. Right, so if you're 70 and you put money into an annuity, you die at 72, the insurance company won that one.
Yeah.
Time. If you live to 120.
Yeah, you really got them.
Right, so it's one of those where there's a lot of negativity on annuities. Because people say, well, in the short term, you know, if I die prematurely, yeah, the insurance company won.
Yeah.
But, you know, if it's structured correctly as one piece of the whole plan, you know, it can make a whole lot of sense. And I think it would be unadvisable to say, okay, Mr. and Mrs. Client, let's put 90% of your assets into this annuity. Now, because you're not going to be liquid, you know, and if you die prematurely, you're not going to get what you want to pay.
It's like you said, yeah, it's a supplement to your other retirement.
I mean, you look at Social Security for as much as it's talked down about. If they could fund it correctly, it's essentially an annuity.
Yeah.
You know, you've funded it your entire working life, and they have to give you a certain percentage back. Now, you can argue if that's done correctly, or if they should
That's a
go
good way to put it, yeah.
and rate it. But that's not something you or I can control. But that's essentially what Social Security is. It's a deferred annuity of sorts.
Yeah, that's a good way to explain it. That is a good way to explain it. So, one thing that you and I have talked a lot about in the past is these insurance products that are good retirement options for small business owners. And that's not something I've seen in the Wall Street Journal, but you and I have talked about this. You mind explaining, hey, what is this insurance product that's good for business owners, and how can they put that together to help make a robust...
Yes, so it would really be just one piece of the whole pie, so to speak, right? If I own a small business, and let's take a hypothetical, I have 10 employees, our cash flow before taxes and insurance and fees and state taxes, all those things, let's say our cash flow is $2 million a year, right? Let's say I'm paying my employees of that $600,000. Then I have health insurance to cover all those things. So I'm left with, say, $1.5 million after it's all said and done. Then I have to pony up to the IRS and the state and give them their pound of flesh, right? If there's a way in which, before I give the state and the IRS 30-40% of whatever's left, I can redirect it so that it's good for my business. And that essentially that same amount of money that would have been allocated to the IRS is then allocated back to my business and is a tax deductible expense.
Wait, so you're kind of getting paid to save money? Is that how it
in a
is?
sense, because
That sounds pretty good.
I didn't write the tax code, right? From what I can tell, there's incentives within the tax code for people that do things that grow the corporation, right?
Yeah.
And ensure that their employees and their families are well taken care of, right? So there's always going to be rules, or at least we hope there are, always going to be rules where they incentivize those things,
Yeah.
right? if you own a construction business and you buy a new concrete truck, right? Unlike a hobbyist who would go out and buy it and spend $100,000 and that would be pure cost. If you own the business, that's a tax deductible expense.
Yeah.
Right, to a point. So same thing here, if you're able to set up pension type options for yourself, your people, and instead of say directing $400,000 towards taxes, you could take that and redirect it back towards your corporation inside of the pension, and having insurance and annuities and things like that be a part of it, so that when the IRS looks at it, they say, okay, this is kosher. This works because it hits this, and this criteria. For a lot of business owners, it makes a lot more sense. Now the caveat's going to be, can you cash flow it? Right? Because if I'm in a business where I have a really great year and I make $10 million, the next year business is awful and I make 20 cents, something like this wouldn't be really sustainable.
Yeah.
Right? So it's those businesses where there's a pretty relatively consistent cash flow, there's good growth, and they're giving a lot of money to the IRS. And
Generally those owners are paying a lot of tax.
And they've already talked to you and you've walked them through what expenses they can back out and what deductions and they kind of maximize that stuff already, right? There's only so many work trucks they can buy, right? There's only so many HVAC repairs that they can write off, right?
Yeah.
So they want to find a way to just give the IRS less. And the thing of it is, it's all backed by actuaries and accountants like yourself and attorneys. So if there's ever an audit, it's all right there.
Yeah, it's right there, and it's a benefit for the owners and the employees in the business.
It's not as if we're doing some kind of secret sauce thing. It's just more of the execution of it, right? And the IRS gives it the green light because, as you said, it's a benefit for the owner, one, and the employees. So, in today's market where generally with the people I talk to, it's harder and harder to keep good people because there's so many options.
Yeah.
This could be one of those incentives where, okay, if you stick with us for X, Y, and Z years, you can get this as a bonus, whatever it might be, right? So it works in that vein, if you will, kind of a golden handcuff type scenario. Now, every business scenario is going to be different. Not every case is the same, right? So you've got to run through and customize it, obviously.
Yeah.
But generally the people we work with on these things, it's, okay, but after my tax deductions, I'm still going to give the IRS $300,000, $400,000, $500,000. Like, is there anything else I can do?
Yeah.
Right. That's when this becomes a conversation. Right. So that's the big picture of it now. Obviously, there's more detail to it, but that's one of those kind of behind the curtain conversations after we get all the numbers back. But yeah,
that's a good strategy that I wasn't aware of until you told me about it, so I wanted you to explain it to everybody else, because I think it's a pretty good one. So, hey, just the next question is, hey, what have you seen happen to people, or that because you've been doing this like your whole professional life, what happened to people that didn't have adequate insurance? I have a bunch of horror stories that I could tell, just from being a tax accountant for 30 years. I've seen the breadwinner pass away, no insurance, and spouses just stuck with debts and bills and can't make ends meet. And I didn't know if you had any.
I mean, unfortunately, those are the ones where you don't get to in time, right? Maybe you've had a conversation with somebody, hey, we should put together X, Y, and Z, and they say, hey, I'll get back to you after I get back from vacation, or let me talk to the attorney first, and we'll get the trust put together, and then they go off and have a stroke before anything's set in stone, and their income stops, and it's not a pleasant thing.
Yeah.
On the flip side of it, the conversations where you've had them in time, you put everything in place, and then the breadwinner dies suddenly of an aneurysm. Absolutely tragic, but I'd much rather know that they have $2 million in place so that the funeral costs are covered and grandkids' education is covered and medical expenses are covered, and the wife at 75 doesn't have to go back to work after she hasn't had a job for 30 years.
Yeah.
Those kind of things are where you want to be. But on the horror story side of it, it's not good, because I think a lot of people think, well, I'm not worth $50 million, so I don't have estate tax issues. This isn't a big deal. Like, I'll live off Social Security and that's fine. Or I don't have enough money to cover any of this stuff anyway. Right? It's one of those pay me now or pay me later scenarios. Either you're going to pay more upfront now and get it all in place and make it work for you, or you're gonna get to the end of the line and have tax issues and have to go back to work. Now, for some people, if you're 70 and you wanna go bag groceries at Walmart, some people, they wanna do that. Generally, the people that I work with, that's not really their dream.
Yeah.
You know,
Yeah.
I've never met someone yet who said, I want to be 75, have my spouse pass away prematurely, and then I have to go find 3 different jobs,
Yeah. That's rough.
you know. So we try to get to that before that happens.
Yeah. That's a sad situation. Kind of like, that's one thing that a lot of people don't want to consider. Kind of like people don't want to call the tax accountant because they don't want to think about taxes. People don't want to call the life insurance guy because they don't want to think about dying. I think it's just one of the mechanisms that it's an uncomfortable subject, but it's an important subject.
There's been one person that didn't die, and I'm not him. So I don't know what to tell you.
Yeah. Well, Corey, if people have other questions, how can they get a hold of you? We'll put your information on the
Sure,
screen
so
here when we're done.
First and foremost, I'd contact your office because we're right down the street from you. And we work together, so that would probably be the easiest. But we're Advisors Accelerated. We're in Lewis Center, so we're real close to Brad's place. Feel free to reach out anytime. 614-530-2884. Julie at our office. She's the contact person. She's the nice one. So talk to her first. But yeah, I would recommend reaching out to your folks and coordinating that way too, because we're on the same team here for all intents and purposes in terms of the holistic view of how all this works together.
Great.
So
Great.
Yeah.
We'll put Corey's information up too. So Corey, thanks for coming in. Appreciate the
Appreciate it.
chat.